Good morning, everybody. Hey, it is John Lone King, and I am super excited to be here with you. It is Friday, the 12th of December, and I'm doing something for the first time today, which is I am streaming live also on Instagram. I'm not sure how well the feed is coming through. It looks like the vertical version of Instagram with my horizontal picture, and it's got it super zoomed in on my face. But whatever. If you're watching on Instagram, thanks for joining us. This is our first time that we are actually broadcasting live to Instagram at the same time. So what the heck is going on? Let's talk about it. So it is Fed week. The Feds came out 2 days ago. They announced lower interest rates. They lowered rates by 0.25%. Everybody expected them to do that. Okay, so that wasn't really the big deal. What made it different this time is that Fed also started buying treasuries again. So this is something that they hadn't done since they started doing it in COVID. They stopped doing it after COVID, and when inflation started taking off in 2022 and the Fed started raising interest rates, they also stopped buying treasury bonds. In other words, supply and demand. And when there aren't enough buyers for bonds, whether it be mortgages or treasury bonds, then the rates will go up. As there are more buyers, the rates come down, and the Fed was a very big buyer. And then they said, we're not going to buy anymore. As of Wednesday, they said they're going to start buying next week again. Now, that isn't as big of a deal as what it had been back during COVID, but it turns the light switch back on for something that's going to help interest rates in general. And the market has responded very, very favorably to that. And so that's actually the first time that we have seen the market reaction to this be good news when the Fed lowered interest rates. And so what's happened before is every other time in the last 2 years that the Fed has lowered interest rates, mortgage rates have gone up right after that. And the reason is because the market had expectations going in that it was party time, that the Fed was going to lower interest rates and give us good news that rates are likely to keep going lower going forward. And every time the Fed pulled the plug and said, nope, party's over. We're not going to give you much good news beyond this. We think this might be as low as we're going to go. We're not really sure if we're going to lower rates next time, just like in October when they talked about the December rate cut. So they cut rates in October, at the end of October. And then they said, hey, by the way, the rate cut in December is not a foregone conclusion, which was their way to pull the plug and say, hold on, back up. We don't necessarily think interest rates are going down as quick as you think. Now, they ended up lowering rates again in December. And so this has partially become kind of like when your parents tell you, hey, you better be good or we're not taking you to Disneyland next week. Well, guess what? They already bought the tickets to Disneyland. They already have the hotel. None of it is refundable. You're going to Disneyland, but they want to convince you that you're not going to get you to act the way they want you to act. That's what the Fed's been doing. And the market's starting to see between the lines. The market's starting to say, hey, wait a second. You keep telling us that you're not going to give us another rate cut, and then you give us another rate cut. And so we're having a hard time now believing the Fed. So that's part of it. And then the second part of it is that what's happened since then. And so basically we saw mortgage rates fall on Thursday. So Wednesday afternoon and Thursday, we saw mortgage rates and treasury rates come down, which was a good sign because they'd kind of gone up some leading into Wednesday's announcement. But then between yesterday and today, we've seen interest rates come up back to where they were on Wednesday. So it's been quite a spiral. I'm going to kind of share my screen here. I have no idea how this is going to show up on Instagram, but let's share here, share my screen, and let's share this screen right here. Perfect. And I will show you what I'm talking about. All right. Oh, good. And Instagram, it just kind of takes over the whole screen. Cool. All right. So what you're seeing here, this is the 10-year treasury rate. This is what treasury is, a version of an investment that that Wall Street can invest in instead of mortgages. And so they move kind of together in a similar direction. And this is the easiest way to kind of track interest rates. And so what we saw is back on December 4th, we saw the 10-year treasury down here at like 4.09, and then it climbed and climbed and climbed until we got to Wednesday. And we hit the peak of 4.20. And then as soon as the announcement came out, rates fell and they fell and they fell through yesterday, and they went back to 4.10. Now we're back up to 4.19. So we're seeing a big yo-yo back and forth, and there's more yo-yo to come because what's going to happen next week is we're going to get another jobs report. So what's happening is the jobs report and the inflation is what matters. And it's about the tug of war, and I've been talking about this over and over again, the tug of war between if jobs are in trouble and we're seeing fewer jobs created, then the Fed is going to keep lowering interest rates to spur employers to spend money and to therefore hire more people. If inflation is a problem, then we're going to see Fed raise interest rates to stop employers from spending money, to stop employers from really paying good wages. That's overly generalized, but that's essentially what they're trying to do, is they're trying to slow down the economy. So if unemployment is a problem, the Fed's trying to speed up the economy by lowering rates. If inflation's a problem, the Fed is trying to slow down the economy by raising rates. They're both a problem. They are both a problem right now. And next Tuesday, there is an off cycle because of the government shutdown. We're finally getting October's jobs numbers next Tuesday. So it's a big day. It's the jobs report that we normally get on the first of the month that we should have really gotten on the 1st of November to get October's numbers, but the federal government was shut down during the entire month of October. So they spent the whole month of October gathering data about unemployment that they give out the first week of November. Well, they basically started the government back up again a month ago. So they spent the last month kind of trying to look back to October to figure out what the jobs numbers did. So this isn't going to be a very valid number, but the market's going to take it that way. And what we saw a lot of the Federal Reserve members, two of them specifically say, no, we don't think rates should have gone down because we think that unemployment isn't as big of a problem as we think it is. Well, guess what? If next Tuesday we end up in a situation where jobs creation is high in October, even though that's when the government was shut down, we're going to be in a position where mortgage rates are going to spike. And so obviously, I'm trying to read the tea leaves here. I told you guys last week that every time that we have had a Fed meeting and they've lowered interest rates, mortgage rates have gone up, and I advised that you would lock before that meeting. Well, the truth is rates got better yesterday, so I was wrong because I'm trying to predict the future. We got another big day next Tuesday, because that big day next Tuesday is what's going to happen with the jobs report. And so if you want to take the risk, float through it. But if you want to know that you're not going to be at the whim of what these not so confident numbers are going to be coming out of the federal government, then you may want to lock on Monday or today. So that's kind of my lock advice as we're moving. What does this mean right now for buyers and sellers and everybody else in the marketplace? So first of all, what we're looking at for buyers, we're still in a great market where we have a lot of inventory compared to a fewer number of people trying to buy. And the question is going to be, how long is that going to last? There's an argument that says we're going to be in this kind of a market for a little while because you have people who are unsure about the economy, they're unsure about the future, and they would rather just stay put. And I think I could make an argument to say that's the case. There's the other argument that says, you know what? People are tired of waiting and they want to make a move. And I am seeing more people in that situation. Now, obviously, my view is biased because I see a lot of people who are looking to buy a home, and I don't have people who are waiting talking to me. So I don't know. There might be way more people waiting, but I'm getting way more activity now than I normally would have in December. What that tells me is January is going to be busy with buyers out there on the market. So if you are shopping for a home right now, what I see is a wave of buyers coming in January and February that are going to be your competition. And so now is the time to get your offer accepted and get into a home. Now, what does this mean for homeowners? So if you are a current homeowner and you are trying to sell your home, you may have better prospects in the coming months, but it depends on whether you're willing to risk it or not. Okay. For some people, I see them taking their house off the market right now and waiting to see what happens. There is an absolute strategy behind that. But you're taking the risk because right now you have a bird in the hand to say, hey, if I got a buyer right now, do I want to risk missing that opportunity for that buyer? And so what we're looking at is we're looking at an opportunity if you're looking to sell to say, hey, maybe if you wait a little bit, wait a few months, you might be in a better position. But we don't expect interest rates to drop significantly in 2026. That's the sad news for everybody, whether you're a buyer or you're a seller. We think rates might tickle into the high fives. They've tickled into the high fives already. I'd love to be wrong, but I don't want you making your plans based on interest rates dropping significantly because I don't see that happening anytime soon. And so at this point, buyers still have a good amount of leverage, and it's an opportunity to take advantage of it. Sellers really do need to be more flexible if they want to get a home sold right away. But here's the other final thing I want to talk about today is equity strategies. If you are a homeowner, by the way, before I finish out with this, if you have questions, feel free to post them onto whatever channel you're on and I'll answer them live. I'll also be coming back live on my Dream for All channel in 20 minutes, talking about some new things with Dream for All and getting prepared for 2026. So if you know somebody who's a first-time home buyer and wants to buy a home in California, stay tuned and jump onto my Dream for All YouTube channel to watch that on live in about 20 minutes. So a lot of homeowners right now have a lot of debt. The truth is it's Christmas time. Christmas time, you have the biggest time of the year that you are adding to your debt. And so you really need to think about how do we strategically use our equity, and don't just automatically jump for the first person that calls you or emails you saying, hey, I can save you money. Because the truth is there's a lot of times when it's a bad idea to do it. And just like there's a lot of fear and uncertainty with income for you or for people that you know in just the general market, there's also the same thing in the mortgage world. The mortgage world overall has been impacted significantly, and you have a lot of starving lenders. Thankfully, I've got a great audience like you and a lot of past clients and realtors that trust me, and so I've maintained my business and done well through even this period of dry opportunity. But just watch out for those sharks. Watch out for those people who are looking out for their best interest instead of yours. And again, don't trust the guy that says, trust me. And here I am saying, trust me. What I'm saying is just be careful who you trust. That's the most important thing I want to be clear about. Be careful who you trust. If you have questions and you're unsure who to trust, scan this QR code above. Click on that link and schedule an appointment with me. Allow me to help guide you, to give you the options that are going to help you to make the right decisions. And so at this point, really, I'm going to open it up to questions. But if you are interested in the Dream for All program, or you know somebody that is, I'll be talking more about it on my Dream for All channel in a few minutes. And I'll be doing a webinar this Monday night with a whole bunch of detail on how it works, how to take advantage of it, tools that I'm providing to help you to figure out if this is a good idea for you or not. Otherwise, guys, I just buckle down during the holiday season. If you are a homeowner and you're trying to sell your home, you've got to be aggressive, because there are fewer buyers out there right now, and there's still more homes listed for sale than the number of buyers that are trying to buy them. And if you are a buyer and you're out there shopping right now, it's a great opportunity. I'm seeing people get seller credits like I haven't seen this much in the past, and I'm concerned that might go away, because at least I am seeing a lot more buyer activity right now that's going to lead to more people wanting to get out and into the shopping mode and writing offers in January and February. So that's about it for what I've got for you. It doesn't look like we have any questions. So switch over to my YouTube, my California Dream for All channel. I'll be on there at 11:45, and you can check that out if you want. And otherwise, have an absolutely wonderful weekend. We'll talk to you again next Friday, and then I'll probably be dark for Christmas, the day after Christmas, and we'll see what happens on January 2nd. I'll probably be back. All right, guys, have an absolutely wonderful weekend, and we'll see you next week. Holler if you need anything. Bye-bye.